So let's start. Why organization needs fund? So if I ask you why do you need money? So you will say that I need money because I have to buy grocery, I have to pay my bills, I have to buy some fixed asset like TV, fridge, something like that. Okay. So likewise, why organization needs fund? So an organization needs fund for their working capital. It means that they need money for their inventory, current asset minus current liability. For example, they need money for inventory. Okay, so in also they need money for the non-current assets for the investment, like they have to buy some land and building, furniture and fixture, and some machinery. Okay. So whenever you borrow, you keep in mind some basic things while choosing your sources of finance. So which type of basic criteria you keep in mind? Basic criteria you keep in mind like how many how much is the rate of interest? How much is the rate of interest? What is the duration of the loan I have to take? What is the for the company, what is the gearing, and is it available for me or not, like. Okay, so before we understand this, let's first understand the difference between debt and equity. So debt is the borrowed fund. It is the borrowed fund. Okay, but the equity is ownership capital. It means if you are the owner of a company, which means you take higher risk, which means the you when you take higher risk, you will when you become owner, you will take higher risk. So in this case the investors higher risk, so no fixed obligation, which means company is not obliged to pay any fixed interest or like dividend. So whenever the dividend is also optional. Okay, so but in on the other hand the debt holders is lower risk because lenders get fixed interest. Lenders get fixed interest and company have to pay, sorry, company, it is lower risk for the lenders but higher risk for the company because company has to pay the interest every whatever the duration they choose for the interest. Okay, but on the other hand the control lenders do not have voting right. It means lenders do not intervene in the business affairs because they are not the owners, but equity holders are the owners and they take the voting rights and they intervene in the business affairs. Okay, so in the liquidation, in times of liquidation, lenders have priority to claim before any equity holders. First we pay to the debt holders, then we pay the equity holders. So residual claim, equity holders has residual claim, but the debt holders has the claim. Okay, so now we will understand some of the criteria we need to keep in mind while choosing the sources of finance. So first is the cost, which means the how much is the interest or dividend, whatever the providers of finance expectation. So this cost is the expectation of providers of finance. So debt holders is cheaper. Why debt holders is cheaper? Because debt holders get because debt is cheaper Why cheaper? Because that is a tax benefit. On the debt we get tax benefit. How we get tax benefit? For example, our pbt is 100, but for the interest we pay 10, for example, then we have left. So this is the profit before tax, then we pay the tax on this. Okay, so which means that by deducting this interest we pay the lower interest, like this. Okay, so let me put another. If there is no interest here, so if there is no interest here, then we have to pay the tax on the 100. So our tax will be higher in this case when there is no debt, and lower in this case. So we get this tax benefit. Because of this tax benefit, the cost of our debt is lower, which means cheaper. Okay, so next is the priority of repayment and receive fixed interest. This is another because this cost is the expectation of the providers of finance, because the debt holders are getting the principal repayment, but equity holders are not getting the principal repayment. Because debt holders are getting the principal repayment and also the fixed interest, which means their expectation is lower than equity holders. If their expectation is lower than equity holders, which means that the cost will be lower. Okay, which means that cost will be lower because their expectation is lower due to repayment of principal, and they are getting the fixed interest. But on the other hand, the dividend is optional, and in the event of repayment, sorry, in case of repayment, there is no repayment of principal. Whatever the amount the equity holders put in the business, the company don't need to repay to the equity holders. So equity holders expectation from the company is higher than the debt holders. So when their expectation equity holders is higher, which means their expectation is higher, which means our cost will be higher as well. Okay, but in case of debt holders, because their expectation is lower, our cost will be lower. I hope you understand this. Okay, next is the duration. What is the duration for which we have to take the fund for this? So duration, if the short term is cheaper, but long term, the risk involved. Due to risk involved, the long term is expensive, but short term is cheaper. Why? Because let me give you an example. So if your friend came to you and asked money from you that I will pay you after 10 days, so you will say that you will think and say that that your friend has a stable job and he will pay you after 10 days, so not a problem at all. So you will definitely say yes to your friend and give money to help your friend. But the same friend, when he asks you that he wants to borrow money for the 6 month or 1 year, then you will think that right now he has the job, and but in the future after 6 months he might lose job, or his financial condition may not be the same. So you have the risk. You anticipated this risk. So when you anticipated this risk, you will probably say to your friend that I cannot give you money because this reason. Okay, if you want to give money to your friend, which means the risk is higher. So whenever you take the higher risk, you also expect the higher risk, which means you also expect the higher reward. So you will say that I want to I want to charge some higher interest. So in this case the for the short term, the short term is cheaper because the interest rate charged by the bank or the providers of finance is lower, the lower rate. But in case of here in the long term, the higher rate of interest will be higher rate of interest on the funds will be charged by the providers of finance. Okay, so next is the gearing. So whenever we borrow money like debt, whenever we fund our whenever we fund our whenever we borrow money from debt, so debt is cheaper, which means debt is cheaper. Why we borrow money from debt holders? Because debt is cheaper. So whenever we add the cheaper finance, which means whenever we increase the debt, our fixed cost, our fixed cost, our fixed cost like interest, our fixed cost is interest. So our fixed cost will increase as well. So in case of so our fixed cost will increase, which means this is the gearing risk. Because in case of decreasing profit, when our profits are decreasing, which means that our profits are decreasing, but our cost will be fixed. So our we have to pay the debt holders a fixed amount of interest. So whenever our profits are decreasing, then we have to pay the interest as well. So our profit will be highly suffered by this. But in case of our profits will be highly suffered. Okay, use optimal. For this we have to use the optimal capital structure. What is optimal capital structure? This is the balance. We have to keep the balance between debt and equity. So okay, we have to make the balance between debt and equity, which is a optimal capital structure. Whenever there is a good balance between debt and equity, that is called the optimal capital structure. We will understand this in the capital structure chapter. Okay, but right now I'm going to the next is the accessibility. Accessibility means not all sources are available to all firms. So for example, if the firm's credit score is not good, then which means that they cannot borrow from the bank. Okay, so they cannot borrow from bank. Or if the other side, if a company don't have big infrastructure, or like it's a small company, then definitely he cannot raise equity finance, because equity holders afraid to invest in new companies and small companies. Between risk and return. So it means that when the risk increases, the reward must be increased. Okay, which means the risk increase, the return should be increased for the providers of finance. Okay, so you can simply ignore this. There is no need to remember. Okay, it simply means when the risk increases, the reward should be increases. Okay, so let's move on to the next. Next one is the how the how the sources of finance is categorized. Sources of finance is categorized into short term and long term. So in the short term we have the bank overdraft. In the short term we have bank overdraft, loan and working capital management, leasing and sale and leaseback. Okay, so what is bank overdraft? Bank overdraft means you can withdraw more than your available balance. If your balance is 1000, if your balance is 1000 pound, you can withdraw you can withdraw more than, you can withdraw more than more than 1000. Okay, so you can withdraw like 1200 or something, or whatever your limit, withdrawal limit is it. Okay, so next is bank loan. Bank loan is fixed short-term borrowing less than 1 year. So when you take money, when you borrow money from the bank, so it is called the bank loan, and it is less than 1 year. So it means the bank loan is current liability. That's why it is in this short-term category. So next is the working capital management. How do you manage the working capital? When you reduce the receivable and inventory days. When you reduce the receivable and inventory days but increase the payable days, which means receivable means from whom you have to receive money, which means these are your debtors, means your asset. So so reduce means take take these receivables, means collect these receivables, collect these receivables as early as possible. Collect these receivable as early as possible, as early as possible. So reduce this receivable days. And in the inventory, which means that if the inventory days is higher, if the inventory days is higher, which means our stock is uh, is stored in the warehouse for the longer time. If our stock is stored in the warehouse for long time, which means our fund will be stuck in this inventory. So we try to sell our inventory as fast as possible. Whatever we can do, like by selling at discount or any other promotional activity, so we have to try to lower down our inventory days, so that our our inventory days is higher. Okay, so if, so that our inventory days is higher, and we collect our money that is stuck in the inventory. So okay, but in case of payable, in case of payable days, we have to increase the payable days, which means that increase the payable days means, it increase the payable days means we have to defer these payments, defer payments, which means these are outsiders money. Payable means we have to pay to the outsiders, which means this is outsiders money. So as long as we defer this payment, which means it is benefit for us when we pay to outsiders, outsiders to after the defined date, then which means that it is benefit for us. So we have to increase this as much as possible. So it is called the working capital management. Okay, it simply means collect our money that is stuck in inventory or receivable as early as possible, but defer the outsiders money as as much as possible. Okay, so leasing is leasing means, leasing is here it's given. Leasing is contractual agreement between two parties. It's a agreement between two parties: the lessor, the owner of the asset, and the lessee, the user of the asset. The lessor is the owner of the asset, but the lessor transfer this asset to the lessee. But lessor this transfer this asset means transfer this asset, and this transfer is called lease. This transfer is called lease. But this transfer is called lease, and this amount that he pay, that the lessee pay, is called the transfer um, lease lease amount. This is the lease amount that lessee pay to the lessor periodically. But who is the owner? Lessor is the owner and he is the user. lessee is the user. Okay, where the lessor grants the lessee the right to use the asset at a specified period in exchange for periodic payment. This is the payment we are getting from the lessee. So this agreement is called leasing. So if the leasing is for short term, for like 1 year or something, then it is called the short term. But if it is greater than 1 year, then it is long term leasing. Okay. Next, in the short-term sources of finance, we have the lease, sale and lease back. In the sale and lease back, the first the first is the first what we do, we sell the asset, then then we take them back, then we lease them back. It means we sell this asset to the other party. If, for example, this is one party and this is another party. So okay, so first we sell this asset, then we lease it back. When we lease it back, okay, when we lease it back, we pay this lease amount that is called the you say this lease a rent or lease amount, you can say. So this is called sale and lease back. When you have the asset that is worth, that is very, I mean the asset is worth of many, I mean, the asset is very big amount. The value of the asset is very big, but you need this money. But because you need the money for the business to buy some other activities, so you sell the asset, and then because you need that asset as well for the for the use in the business, so what you do, you lease it back. Means you sell your own asset and take this asset on rent, and you pay the rent. Okay. Next, next we have the long-term sources of finance. So in long-term sources of finance, we have the equity, debt, and hybrid. Okay. So in the equity, we have the numerical questions for this. This is the TERP and right issue that we will solve. We will solve, and the debt is another sources of finance. And hybrid means you issue it as a debt, but there is option that these debt holders can convert their debt into equity. This is also called convertible debenture. Okay. So next is the bank loan. So when the fixed long-term borrowing, this is called fixed long-term borrowing more than 1 year. When you borrow money from the bank for more than 1 year, it is called the bank loan. Long-term bank loan. Okay, leasing we already studied, already know this. So next is the venture capital. So if you want more sources of finance, then we have, nowadays the venture capital is very very frequently. So next is the venture capital. The venture capital is the another way of getting funding from the providers of finance. So these are the venture capitalists who provide the venture capital. The venture capitalists provide the venture capital. Okay, this is the risk bearing capital, which means they take the risk as take the risk as equity holders and form part usually in the form of participation in equity. It is similar to equity. So it is similar to equity, so to companies with high growth potential. High growth potential, when the companies have high growth potential, the venture capitalist seek venture capitalists assess their investment prospect, and they invest in these companies. So it is called, when they invest in these companies, so it is called venture capitalist assess this investment prospect, and they invest in these companies, and this capital is called venture capital. And this venture capital is like equity, and it is risk bearing, which means that venture capitalists take the risk of profit and loss in the business. So how do they assess the investment prospect of the businesses? How do they assess the business performance? They assess the business performance while when they consider investing. They consider investing by looking at their financial outlook. How their future, how their financial future look like, what will be their future profits, how they how they are managed. So like this. Okay, so next is the management credibility and technical abilities. Who are the promoters, who are the directors? Are they good people? Are they have any previous fraud? They do have any previous fraud background, or have any committed any financial frauds in the past? So when investing, the venture capitalist consider all these, and are they competent enough to manage the businesses? So they also assess their experience of managing the companies like this. Okay, so they also assess the market. They also assess the market. They also assess the market. How is the future of the this company's products and services? How the market of the how the how much market share this company has, and how is the product and services currently they are producing. So is there any future of these products and services? So the all these things they consider while investing in the businesses. So further is the degree of influence offered. So if degree of influence offered when investing in a business, the companies offer the venture capitalist the controlling stake or board stake. So either they control these, or they take the board seat. So either they control this or take the board seat, or can do both, like this. Okay, so also they consider if is there any exit route, what are the exit routes, can their shares are marketable enough, or their shares can be sold easily in the market after. Okay, so class, there are different types of share capital. The this one is the first one is the ordinary share capital. Okay, so the ordinary share capital, preference share capital, we have the cumulative and non-cumulative. Okay, so in the preference, in the ordinary share capital, the shareholders have the voting right in the general meeting of the company. Okay, so they have the voting right in the however in the cumulative they have the voting right in general, but they have the voting right but only in case of there is an area, and in case of or in case of there is a change in the legal rights. So we will understand this later. So first we understand that the voting right, ordinary shareholders have voting right. Okay, and the next is they rank after all the creditors. It means rank after all creditors and preference shares in case of liquidation. So in case of liquidation, when when the company's assets are liquidated, in case of liquidation, when company's assets are liquidated, and the whatever the amount the company owns, that will be given to the to the so, to the providers of the finance. So okay, so first we pay to the creditors, first we pay to the creditors, then we pay to the debtors, then we pay to the debtors. Okay, or loan note holders, loan note, or we can say that bank. Okay, and third we pay to the preference shareholders. It can be cumulative and non-cumulative, both are here. Okay, and at the end we pay to the ordinary shareholders, ordinary share capital or ordinary shareholders. Okay, so this is the liquidation. This is the preference we give in case of liquidation. The way we distribute our funds in case of liquidation. Okay, so this have the voting right and rank after. Okay, so the income, for the income we have this dividend for the ordinary shareholders. We pay the dividend to the ordinary shareholders, but it is the discretions, at the discretion of this of the directors, which means that this dividend is optional. This dividend is optional. If the directors choose not to give the dividend to the shareholders, then they can do so as well. So this is an optional thing. Dividend is an optional. Okay, so out of undistributed profit remaining after prior claims have been made. What does it mean? Okay, let me explain this. What does it mean? It means that PBIT. Okay, PBIT. Okay, and then we pay to the debt holders the interest. Then what we have, the profit before tax. Then we have the profit before tax. Then we pay the tax. Then we pay the tax. Then we have profit after tax. After this profit after tax, or we can say that this is the available for the distribution. This profit is available for distribution to the shareholders, which includes preference shareholder and equity shareholders. So first we pay to the preference shareholders. First we say pay to the preference shareholders. If any dividend, we pay to the preference shareholders, then we pay to them. Then this amount available to equity shareholders, available to equity shareholders. This amount we pay to the dividend. Dividend is for equity shareholders. This dividend is for equity shareholders, which means that this dividend we paid at the end, after paying the debt holders, after we paying to the debt holders, after we paying the tax, after we paying to the preference shareholders, then we pay to the ordinary shareholders or equity shareholders. Okay, or equity shareholders, you can say. So this means that undistributable profit, out of undistributable profits remaining after the prior claims have been made. Okay, The next is the right to surplus funds after prior claims have been met. After prior claims have been met. What does it mean? It means that this is the right. It means right to any surplus funds. If there is any left, if there is any left after paying in case of liquidation, when company liquidate, then after paying to the creditors, then debtors, sorry, debt holders. Okay, this is the debt holders, not debtors. After paying to the debt holders, bank loan and preference shareholders, then at the end we pay to the equity shareholders. At the end we pay to the equity shareholders. So this right is called surplus fund. If there are any surplus funds, if there is no funds available here, then we don't pay to the equity shareholders, which means that if any surplus is available, then we only pay to the equity shareholders, ordinary shareholders. Okay, so this is all about ordinary shareholders. Next is the cumulative preference shares. The cumulative preference share means that it is the preferential right. Preferential right. Shares means they have the preferential right. Preferential right. Preferential right in case of dividend and liquidation. They have the preferential right in case of dividend and liquidation. What does it mean? It means they get their dividend before the equity shareholders. This means they given preference before the ordinary shareholders. So this is the case of dividend. In case of liquidation, they also given the preference before the ordinary share capital. Okay, so they have the preferential right. So the what is the cumulative means accumulate. You know what is accumulate means adding. Okay, adding. Accumulate means if there is any pending dividends, in any year, this will accumulate. Okay, right? So the limited right to vote at a general meeting. Limited right to a vote means they also have the right to vote. But it's limited only for the two things: when they have the dividend in area, or if there is any change in the legal rights. If there are any change in this right, then they can vote, or if there is any area in the dividend, then they can vote. Okay, next, rank after all creditors but before ordinary share capitals. Rank is after all creditors and debt holders. After this it is here, but it is before this, right? It is before this. Okay, so next is the a fixed amount per year at the discretion. The preferential shareholders get the fixed amount of dividend at the discretion of directors, which means that the directors can decide. If they can decide that in year one we have to pay dividend, in year two we don't pay dividend, in year three we will pay dividend, then they can do so this as well in case of cumulative preference share. So this is called the, sorry, in case of cumulative preference shares. So a fixed amount at the discretion of directors, and any area accumulate and must be paid before dividend on ordinary shares paid. So if this is not paid in the second year, then it must be paid in the next year. So if they have the 10 here, 10 here. If they have not paid the 10 here, then they have to pay the 20 in the third year. So this dividend must be paid in the third year, which means this accumulate until it is paid. Okay. Next is the a fixed amount per share is given. Okay, right? But in this case, if any surplus is available, but it is obligation that a fixed amount should be paid. Okay, so it's here as well a fixed amount. So non-cumulative, the only difference is the cumulative and non-cumulative is that they typically uh, they typically acquire some voting right. They have the voting right as well, but the voting right, if dividend has not been paid for more than 3 years, if the dividend is not paid for more than 3 years, which means that if dividend is not paid in first year, second year, and third year, then this is the non-cumulative, right? It means that if any pending dividend, then it will not be paid. But in case of if not paid for the 3 consecutive years, then they have the right to vote, and they become the if it is not paid for 3 consecutive years, then they automatically convert into cumulative, right? But if this dividend is not paid like this, in case of first year it is paid, so first year it is paid, but in second year is not paid, but in third year it is paid, which means this is not consecutive non payment of three in the 3 year. So in this case it does not accumulate, it only will be the 10, right? I hope you understand this. The income is the fixed amount for the providers of the finance, the fixed amount that we pay areas to not accumulate. Okay, we already know this. So next is the how can we raise the equity? How can we raise the equity? There are three sources of equity we can raise. Three sources of equity finance by which we can raise the equity. The first is the retained earning. This is the internally generated funds, which means that if any profit available after paying the interest, tax, and preference share dividend, and if anything is available, then we can or ordinary share dividend, if anything is available, then it is retained earning, it goes to retained earning. Okay, so it is optional, so you can also don't pay this and strictly goes to retained earning, right? So this retained earning we can use in future. So this is also another source of finance, and its internally generated sources of finance. The another is right issue. Right issue is another source of equity finance, which means that issuing the equity shares, issue equity shares to existing shareholders. So we don't offer to the new shareholders, instead we offer this to the existing shareholders. Okay, so another is the new issue, which means we issue to new shareholders. Okay, is called also known as placing and offer for sale. So the this topic next is the right issue. This topic is very important, yeah, in this chapter. So there are lots of questions that can be asked on this, and we will solve in this lecture as well. And you have to understand this in very detail. I will teach you every single step, how to solve the questions, the concepts. So you just have to be attentive, right? You have to be attentive. It is not difficult, but it creates some doubts and confusion, but I will solve every doubt and confusion. So you don't need to worry about all these. Just be with me and listen to me attentively. Okay. So the right issue is an offer. Okay, it's an offer. Offer means you can accept or reject. Offer means you can accept or reject. Okay, so offer is given to existing shareholders. This offer is given to existing shareholders. They can accept or reject. Subscribe for the new shares, which means they buy the new shares. To buy the new shares at a discounted than the current market value. It means that they are given the offer. They are given the offer to existing shareholders that you can buy the shares at lower price than the current market value. Okay, so in proportion, in what proportion? In proportion to their existing shareholding. Okay, so it why companies like why companies like this, and you prefer to raise finance using this method? Because it is cheaper. Because it is cheaper than public issue. Why it is cheaper? Because there is no need to issue, no need to do marketing. Okay, there is no need to do marketing, no need to find find shareholders, or you can say the placing. You can say that some companies that provide the placing services, like if the company, if the shareholders do not invest in the companies for a certain amount, then they give that amount and they subscribe that shares. Okay, so companies don't need to worry about all these, due to because they are issuing to the uh, to the existing shareholders. Okay, so either they accept or reject. They have the only two options. When they accept, they will buy. When they buy, the companies get the money, and so they get the fund. Okay, but when they don't want, then they transfer this right. Because if they don't transfer, then they lose money. Because if don't transfer, then they lose money. Why they lose money? Because after the right issue, the share price will go down. This is also known as TERP, theoretical exercise price. We will calculate this. After the right issue, the share price will go down, because the number of shares will increase in the market. So that's why the prices go down. So so um, they have to either accept or reject. Otherwise, there is a big loss for them, because the share prices will go down, and their their value, their portfolio will be in loss. Or you can say that in the loss by due to this share price. Okay, decrease in share price. So it is made at the discretion of the directors, which means that directors can decide either the right issue should be issued or not. So it is not required to take any type of consent from shareholders, or equity, or stock exchange. So if directors decided that they want to issue the right issue, then they can issue. They don't need any consent from outside of the organization. They don't need consent from outside, like stock exchange. Okay, so it rarely fails. Why it rarely fails? I already told that after the right issue, the share price will fall. If the share price will fall, which means that shareholders, those are the existing shareholders, will lose, will their portfolio will their portfolio value will decrease. So this is a loss for them. So they prefer, instead they I mean they get lost. Instead I mean they instead they instead they find instead of getting lost due to this decrease in share price, they instead prefer to transfer this at some commission, or at some commission, like any sort of commission they charge to the other party. They transfer this right to the other party and charge some commission. Okay, so that's why the other party will subscribe, and company will get the fund. So it means that it don't fail in either case. Either they accept or reject, which means that they transfer. So in either case the company get the finance, the funds. So it rarely fails, right? Okay. TERP, theoretical exit price. It is the price after the right issue. Which means this is the price after the right issue. Okay. So it is not the actual price, but it is the calculated price that we calculated. It means that it is theoretical price, not actual. Okay. So it is theoretical price and it is X, right? Which means that it is excluding right. Which means that excluding right means after the right. After the right. If this price is before the right, which means that it is come right. Okay, but it is X, right? Which means after the right price. Okay, after the right price. Theoretical means it is not actual, and X right means it is after the right issue. Okay, so theoretical X right price. Okay, and it is calculated by finding the weighted average of the old price and the right price weighted by the number of shares. It is the formula that we will learn here. It is the same thing. Okay, so X right price is market value of shares already in use. Okay, already in use, and those are the new issue already, and from the proceeds of the new issue. Market value of the already in issue and the proceeds from the new issue. Okay, and divided by the number of shares in issue after the right issue. Number of shares after the right issue, X, right? Okay, so this is the formula that we have to understand for the X right price, to calculate the X right price. So let's do this example, and uh, we have to calculate the TERP, theoretical exercise price. Babel company has a issued capital of 2 million shares, having current market value $2.7 each. Okay, and makes a right issue for every two. Okay, one new share for two existing. Okay, one new share for every two existing. Okay, so which means that how many new shares will these existing owners will get? How many new shares? How many new shares? How many new right issue shares? The existing shares will get 2 million, 2 million divided by, which means 2 for every one. 2 for everyone, which means how many? 1 million in total. 1 million in total. Okay, 1 million in total new issue, new right issue of shares. Okay, but just remember that we need to apply this formula and need to calculate this TERP. So you don't need to worry about this. I just calculated for the understanding. Okay, so the formula is the market value of existing share, which means that market value is the current price is 2.7. Okay, current price is 2.7, and the at which the new shares will be issued is 2.1. Okay, so new shares is issued at 2.1 and existing shares value is 2.7. Okay, so for every two shares they will get one. Okay, for every two they will get one. Okay, this is the proceeds from the new right issue. Okay, this is the proceeds from new issue. So this is the proceeds from new issue. Okay, and what is the market value of existing? We have the already have the two, which means we already have the two shares. So this is the market value of existing share, and this is the proceeds from the new issue, and the number of shares we already have after the new issue, which means we already have the two plus we get one new after the right issue, which means in total we have now the three shares. Okay, so for the three shares the TERP will be $2.5 per share. We can calculate this in per share or in total, but I would recommend you that you should calculate this per share, because the calculation is very simple in this. But if you want to go ahead with this long form, or if you want to calculate this in the total value basis, then you can calculate this as well. So let's understand this as well. So this is the 2 million shares, 2 million shares at each current market value. This means this is the total value of existing shares. This is the total value of existing shares. So we have already put here, and how many new shares they will get for 2 million multiplied by 1, and proceeds from new issue. This is the new issue proceeds. So this one is the 2.1. Okay, so we already have 2 million, which means that we will get 1 million more, this one 1 million more. So now we have the 3 million. Okay, so now we have calculated this the same answer, but this is in total, this is in per per share calculation. But you calculated this in total basis, then you have to divide this by 3 million, and the answer will also be in the per share. Okay, so this is the TERP. You should follow this one. This is easy to understand. Okay, so next is the value of right. It means that if the right issued if the shares is issued to existing shareholders, which means it is issued at the discount. Discount means they have the right, and this is the right issue is the right issue is the offer, which means it is the right, not the obligation. It is the right to buy or the offer. You can accept this or reject this. You can accept it either or reject this. Okay, so which means this is the right. So you can, when you reject, you transfer, right? You transfer this, and when you transfer this to the other party, then the other party will give some commission. It will give you the commission. Okay, you transfer this and they will give you commission. So which means that this right issue has the value. So if this has the value, then it can be traded at the stock exchange. Do you know what is stock exchange? Stock exchange is a place, is a organization where where the where so stock exchange or stock market is a market where is a stock exchange or stock market is a what? Is a market where financial instrument like equity, debt, or you can say bond, etc. are are UUGST bought or sold. It means it is a market where financial instruments are bought or sold. What are some of the examples? Some of the examples are like in UK, there is London Stock Exchange. Okay, in US, you have the NASDAQ, NASDAQ, uh, New York Stock Exchange also in the US, and like in some other countries like Tokyo Stock Exchange in Japan. Okay, so let's do this. Let's understand this value of right. So value of right is the right that we can, I mean, we can sell to another person and mm, get some commission. Okay, so how can we calculate this value of a right? So if, for example, this is the market price, this bar is the whole bar is the market price. Okay, this whole bar from here to here, this whole bar is the market price. Right issue issued at discount, which means that to encourage the to take up. Okay, so this is the right issue, but the theoretical X right price, the theoretical X right price is the below than the market value, but it is greater than the issue price. Okay, so the difference between this, the TERP and the issue price is the what is the value of right that we are getting the benefit. Okay, so value after the theoretical X right price, the theoretical after the right issue, this is the price. So and the issued price at right issue issued price is this. So we can calculate the value of right. Okay, so we can another question that can be asked in the exam, that you have to calculate the value of right for existing share. So you have to do the same figure, same. Okay, then you have just to divide it by number of shares needed to obtain a right, number of shares that needed to be that required to obtain a right. Okay, since right has a value, since right has a value, I already told you that right has a value. So which means that it can be sold on a stock exchange for this period, in which period the when the right issued being announced and the rights to existing shareholders being issued, when the right announced to issued, when the right announced to issued, and when actually taking place. Okay, so in this period the right, this right uh, can be traded, or you can say sold on the stock exchange, okay, for some commission if you don't want the right, okay. So let's do this question is very can be frequently asked in the exam. So what is the value of the right? What is the value of the right of Babel company? Babel company we already did this question, but we have to further calculate these. Okay, so you know the what is the theoretical X right price? This is the theoretical X right price minus issue price. This is the EERP, and this is the issue price of right at which you can get the right. Okay, this means you can get the right at 2.1. This is the issue price. Okay, so TERP is 2.5. We already calculated this one, right? 2.5 minus the issue price, this one. So the value of right is dollar 0.4, okay, per share issued. So now we have to calculate the value of right for existing share. So we have to divide it by number of shares needed to obtain a right. Okay. So number of shares needed to obtain right. Number of shares needed to obtain right is 2, because we need two shares to get one share of right issue, okay. Two share to get one, okay. So we need two, okay. So you have to divide it, zero point 0.4 divided by 2, so you have the 0.20, okay. When company issues the right issue to existing shareholders, so then they have the option that they have the option that they can either buy this right, okay, or renounce. This means transfer this right, transfer, or yes, renounce this right and sell them. Means transfer and sell them means, or you can say buy or sell something, or you can say transfer, okay. So transfer and take up the right, renounce the part. You can also transfer the 50-50. You can say, oh, like 50% you take to your side and 50% you transferred, okay. So for example, this one you buy and this one you, and you can also do nothing for your offer that is offered by the company. So let's do the question, but this option is not beneficial. This option is not beneficial for you. I will tell you why. So, which of the following options take up the right, sell, or do nothing? Okay, Bevel Company has a issued capital 2 million shares having current market value to make a right issue of one new share for every two, one new for every two existing, and one new for existing at a price of 2.1. B has 1000 shares in Babel before the right issue, before the right offer. So calculate the effect on the net wealth net wealth of B of the following options. If they take up the right and sell the right or do nothing, okay. So if so this is the This is the right issue, that this is the existing, and this one is the offer for 241 142, and this is the come right price. This is the X right price after, and so you can say that this is TERP, theoretical X right price. We already calculated this. This is the same price that we have calculated, is 2.1. Okay. 2.1, 5, and 2.1 dollar is the issue price, and we already calculated this value of right is 0.440 dollar. Okay, in, you can say 40 cent. Come right price is the market price of the shares before the right issue. So before wealth before the right issue, what is the wealth before the right issue? They have the 1,000 shares, and what is the come right price? This is the come right price, 2.7. So this is the cause. Uh, this one is the current market value. Okay, this one is the current market value. So we have to use this for the wealth, for the current wealth. Okay, so wealth after you have the 1,000, you have the 1,000, you have 1,000 already, but you buy one for, you buy one for every two. It means you additional is 500 more. So total you have the 1,500. And what is the price now? Now is the price when you take, you will the theoretical X right price will be the 2.5. But you paid for this, you, because you buy this right issue, so you paid 2.1, so you have to deduct your cost, so your net wealth is 2,700. So there is no change. But what happens if you sell the right? So you have the 1,000. After this, you after, means after, you have to use the after rate, after, which means TERP. Okay, means after means TERP rate, vertical X right price. Okay, so 2.5, 2,500. You cash received from sale. What is the commission that you received by selling the right? You received 500. You sell the 500 shares right for 4.40. So you get 200 additional income. Okay, so your wealth is 2,700 again as well. So when you do nothing, so you have the 1,000, you use the after TERP, which is TERP rate. The after means the price after the right issue, or it is called theoretical X right price. Okay, so this is the price and you did nothing, so ultimately you have the 2,500. But the actual price that is currently in the market, before it was 2,700, but now because of theoretical X right price, the price decreased, so you lost $200 due to doing nothing. Okay, so this option is not beneficial at all. So therefore the wealth of three option is less than the option, so doing nothing theoretically eventually for the right of new shares. The wealth of the investors who take up the right appears to be unchanged, that one. Okay, so let's move on. choosing between the sources of equity. So when you choose the equity, which I mean the what are the things you keep in mind when you choose the equity as a source of finance? Okay, so when choosing the between the sources of equity, account must be taken of factors. Consider these factors when you take the equity as a finance. Okay, so accessibility of the finance. So equity finance is not available to everyone. So for example, if you are a SME, for an SME, equity finance is not available because the equity finance is mostly available to big organizations who have the history of good management, good profitability. But the SME is not a big organization, and they don't usually have the long history, and some and they are not publicly accountable, and their financials are not audited. That's why they are for them it's not easy to get equity finance. Okay, so this equity is not available to them. But in case of the large organization, it is available. So you have to consider the accessibility, which source of finance is available to you. Okay, so how much amount of finance do you need? You have to consider that as well. Because so next is the cost of issue. In case of cost of issue, so in case of equity finance, the issue cost is very big. So most sometimes these organizations like SME, they don't have they don't want to spend so much amount on these marketing, and like issuing prospects, going to the underwriting and giving them commission. So it is lot of cost involved in that. So for them it is not good for them. Okay, so again, the pricing, you have to decide the at which price you have to issue the equity shares. So if you decide to issue the shares at lower price, it means you issue the shares at discounted price. So if you issue shares at discounted price, it may be oversubscribed. If the oversubscribed means that the available shares are the the s- the people who wants to buy the shares. Okay, but in case of higher price, it can be under subscribed. It means that people are not interested in buying the shares of this company. So that's why it's really important that you have to consider what can be the price of the issue. For this arrangement, the investment bank help the company, and they charge the some commission for deciding this. So okay, another is the control. If you want to dilute the control, which means you want to make more owners in your company. So if you want to dilute the ownership, so you can go for equity. But if you don't want to dilute, if you don't want to dilute, it means if you don't want to make more and more owners in your company, then you can go for debt. Okay, so all these things we have to consider when deciding the sources of equity. So another is the dividend policy. So using retained earning could impact share price. So again, the dividend policy we have to decide that when taking the sources of equity, when taking the equity finance, we have to tell them that we are going to give you this much interest, and or because of relative issue cost and the ease of organization, the most important source of equity is retained earning, then right issue, then new issue. Okay, so as a the best issue is because there is no marketing in cost in this, there is no issue cost, so this is the best option. And again is the right issue because the right issue you have to either subscribe, you have to buy, or you have to transfer. In both case the company will get the finance. Okay, then you have to use at the end, you have to use the new issue. Okay, so this is the next is the long-term source of finance, that is debt that can be redeemable or irredeemable. Redeemable means principal will be payable. Irredeemable means principal will not be payable. So in both cases, the interest you will get every year, but at the end of the your maturity, you will get the principal. In this case you will not get the principal. Okay, in this case you will get principal, but in this case you will not get the principal, so that's why it is called irredeemable. Okay. Okay, so the next is deep discount bond and zero coupon bond and long term debt or bond, you can say. So for this I will explain you what is bond first. So bond is a written acknowledgement of a debt, written acknowledgement of a debt by the company. It contains provision of payment of interest when the payment of interest will be given, and when the repayment will be done by the company. Okay, and what is the rate of interest? The percentage of rate of interest when and when the interest will be paid, and when the repayment will be made. Okay, when the repayment will be made. So this is the acknowledgement. So the bond is also known as debenture, loan note, or loan stock. You can say bond is a debenture. Bond is also known as loan note or loan stock. It means the same thing. Okay. So they are traded on stock exchange in much same way as shares. They are traded on stock exchange as well, usually denominated in $100 as nominal value. The nominal value is $100, and maybe nominal value means the value that is considered the actual value of the debt. Okay, so maybe secured and unsecured. So that can be secured or unsecured. If it is secured, then it can be charged, is charged over uh, specific assets like building, mortgage, or fixed asset, or a floating charge. It is or all assets, one specific asset or all assets, and it can be specific. This is specific specific asset. This can be on floating charge, which means not a specific, but so many assets. Okay, so only for the loan note holders can appoint an insolvency practitioner to administer the assets until the interest is paid. So in case of default, if the company don't pay the interest and the repayment, then the loan note holders or debenture holders, and they can appoint the insolvency practitioner, and they try to insolvent the company and get their money back. Okay. Alternatively, the assets can be sold to repay the principal. So if the company wants to repay, then they can be in the assets that are charged over or against the secured debt. They can be sold, and the company will pay these to the uh, to the providers finance. So what is zero coupon bond? In zero coupon bond, it is issued at a discount. So if the nominal value is 100, so it issued at discount, which means that it issue price is 80. Then you get the interest every, for example, it is for 5 years, then you get 10, 10, 10, 10, 10 here. Okay, at the end you will get the repayment, and you will get your repaid at nominal value. Repay at R is the nominal value. But in case of deep discount bond, this is also issued at this one is the deep discount bond, this one is the zero coupon bond. It is all same, but it is issued at discount, same, but no interest, no interest, no interest, no interest, no interest, and it is repaid at the par or nominal value. Okay, so no interest. The only difference is between deep discount and zero coupon, that zero coupon bond don't pay the interest. Okay, so in this case, the deep discount bond, the 20 here is the income, and this 10 interest is the income of the deep discount bond holder. Okay, but in this case the only income is the 20. So the next is the long-term bond, usually in the form of debenture or loan note holders, is frequently used as a source of finance as an alternative to equity. So you know the what is the debt. You know the what is debt, and we already discussed this, that debt is a fixed rate of on which that is a agreement between the company and the provider, that company will pay the fixed interest, and at the end he will repay the principal amount as well. Okay. So this illustration, if a company has 5% 2021 loan notes redeemable at nominal value, generally the nominal value is 100. Okay. Okay, so quoted at 95x interest. This description refers to loan note that this description, what does this description tell us? That this is the interest rate of the loan note, or you can say this as a debt. and will be the maturity date when this will be redeemable. So pay interest at 5% on nominal value. Okay, so this 5% is the interest on what it will be calculated. It will be calculated on the nominal value. So nominal value is 100. So 100 multiplied 5%. So you have the interest as 5%. Okay. So it will be redeemable in 2021. Will be repaid at nominal value. So redeemable at nominal value 100 and repaid 100. Okay. So currently the market value of 95 per dollar without the right of the current year's interest. Currently have a market value of quoted at, this is the market value. This is the current market value. Okay. So what are the characteristics of loan note and other long-term debt? So the first advantage that from the point of view of investors, that the debt is low risk because it is secured against the assets of the company, or in case of liquidation they will be paid first. We already know that in case of liquidation, debt holders will be given the priority to repay their debt, and also the every year they get the interest. So which means that from the point of view of the investors, there is a low risk of default, of the repayment and interest interest for the from the company. Okay, so from the company point of view, what are the advantages? The advantages is it is cheap. Why cheap? Because they are paying the fixed interest. So paying the fixed interest, that is fixed interest is fixed. So if they are paying the fixed interest, and because their risk is less, because they are taking the less risk, so their expectation is low, expectation is lower. So lower expectations means the cost, their interest rate will be low, which means they also demand the lower interest than the equity holders, because equity holders are taking the higher risk, so they demand higher reward. But the debt holders are not taking much risk, so they demand the lower interest rate. Okay. Also because it's cheap, because the interest is deductible before the tax, which means that tax is payable after deducting the interest. So which means that tax is lower due to interest being charged in the profit. So okay, another benefit for the company, it has a predictable cash flow because the interest rate is already defined, and you know how much the interest will be paid in the future every year. So it is predictable cash flow, no dilute of control. You know that debt holders don't have voting right, or voting right, which means that they cannot they cannot they cannot okay, wait, because they don't have the voting right, which means that they cannot in they cannot manage the business affairs. Okay, so they cannot manage business affairs. So next is the disadvantage. What are the disadvantages from the point of view investor? Because they don't have the voting right. So disadvantage for the investors, is inflexible because you have to pay the interest every year, and in case of you don't have the profit enough, then you also have to pay the interest even if you don't have the profit. So this is the drawback, and this is the disadvantage for the companies. It is not inflexible. It means it is not flexible. It is not flexible. Okay, because you have the obligation to pay the interest. So increased risk at higher level of gearing. So when the gearing increases, which means that increase in gearing means increase in fixed cost, which is interest. So when the fixed cost increase and your profits in your profits decrease by any year, in a in any year, if your profits decreased and you have to pay the interest, then this is the financial gearing risk, which means that your gearing is increased and you face the financial risk. Okay, so must normally be repaid, which means that you have to repay the principal. You have to repay the principal. When you repay the principal, this is the disadvantage for the company. But in case of equity holders are the owners, and company don't pay repay the capital to the equity holders. Okay, so this is the disadvantage for the company. Next is the hybrid convertibles. Hybrid convertibles are some type of finance that have elements of both debt and equity. It means that you have the characteristics of debt and equity. Convertible loan notes issued, which means that convertibles give the holder right to convert to other securities, normally ordinary shares issued as issued as debt, but you can convert you can convert into equity. You can convert it into equity. So that's why it is called convertible and uh, hybrid, you can say. Okay, so it is converted into predetermined price or predetermined ratio. So notes can be converted into shares at a value of 400 per share. Okay, so it can be also 400 per share. That is the price. You can convert it into, or you can convert it into dollar uh, dollar 100 stock into 25 ordinary shares. So this is the ratio in which you can convert, but this is the price at which you can convert. Okay. Conversion premium. When premium occurs when the market value of convertible is greater than the market value of convertible stock is greater than market value of stock to be converted into market value of stock that is held to you, held in your you have the shares. Okay, So stock trading at 102 to be converted into 10 shares, currently trading at 9 each, and has a conversion premium of. So what is the conversion premium? Conversion premium, that is trading at 102, which means that it is the market value of the convertible, and it is converted into 10 shares. It is converted into 10 shares, and that is trading at 9 each. That is trading at 9 each. So how much is the premium? $12 is the premium. So $12 is the premium, and you have the existing shares that is converted uh, that is converted into 10 shares. So you have to divide it by 10. So $1.2 per share is the premium. Okay, next is the hybrid. Hybrid is the loan note with warrants. Hybrid means, sorry, the hybrid, this is the part of hybrid, this is convertible, this is loan note with warrant. Loan note with warrant. What is warrant? Warrant give the holder right to subscribe a fixed future date, fixed future date at a certain number of ordinary shares at predetermined price. It is like the right issue, but it means you have to buy. There is no option. There is no option to give anyone else. Okay, so warrant means grab. Warrant means grab. So you can grab the shares at fixed future date, certain number of ordinary share at predetermined price. Okay, you can grab these shares at this date, this number of shares at this price. So if the warrants issued with loan note, so loan notes are not converted into equity. Instead, bond holders make the cash payment of the shares. Means it is not converted. It is not converted. Instead, you have the option to buy these shares. You buy as usual, and you continue your loan note. So you have the option to buy this amount. Okay, so you make payment, but there is no conversion of your loan note. You continue taking interest on your debt and the repayment amount, but in addition you buy shares at discounted discounted price on a future date. So this benefit is called the warrant. Okay, next is the small and medium enterprise. Small and medium enterprise are, what are small and medium enterprise? Small and medium enterprise are typically defined by the number of employees. They have the few employees. Annual turnover is lower. In some law and IFRS, there is a definition that in some countries as well, that if the annual turnover of a entity is this amount, then it is considered as a small and medium enterprise. And also, if the number of employees is for example, less than 500 or 100, then it is called as small and medium enterprise. So the ownership is privately owned and operated. Okay, it is a not a publicly owned company. Okay. Problems in getting the finance. What are the problems that SME face when getting the finance? Lack of business history, because SMEs don't have the long history. Yes, so that's why they face problem in getting the finance. because of lack of history, people don't trust, because the investors don't trust them and afraid to give finance. Okay, because they see the because they see them as a risky business. Okay. So another problem they face is the lower level of public scrutiny, because they are not the publicly accountable. They are not publicly accountable, which means they are not audited. Their accounts are not audited. Their accounts are not audited, and their records are not accurate, and they have the error, and might be some fraud as well. So that's why they face the problem that in getting the finance. Another is the lack of internal controls, because they are owned by the private owners, and usually the owner is the person who take care of all the things. So they don't have much highly regulated internal controls over the things. So, and lack of governance. So that's why they for these reasons they face the difficulty in getting the finance. Okay, so these are the problems. So different types of funding gap. What is funding gap? Because these companies, small and medium enterprise, face difficulties in finding the finance, getting the finance. So their finance is the gap, because they cannot because they want the finance, but they cannot get the finance. So this gap is defined in the funding gap and maturity gap, and as funding gap and maturity gap. What is funding gap? Funding gap is the ability of the company that they can use and that is available to them. This is called funding gap. Okay, so this gap may be bridged in a number of ways, but this gap can be bridged in by using the following ways. How can this be bridged? Through business angels. So investment funding provided by high net worth individuals. So business angels are the people who invest in. They are the highly net worth individuals. So usually they look for businesses who are high growth potential, and they are in the early stage of business with high growth potential. So they look for the businesses to invest into, so they can bridge the gap of finance through the business angels. Okay, so next is capital. When venture capitalist is the investor firms who provide funding to early stage businesses, high growth business, in exchange for the equity. So venture capitalists are the firms which provide finances in exchange for the equity. So these are another provider of the finance to SMEs. Also, the government encourage SMEs, so they give the give the give the tax incentive or subsidy by different ways to encourage the small and medium enterprise. The supply chain finance. What is supply chain finance? It means managing the working capital of business within a supply chain. It means that sell inventory sell inventory fast take, collect, or I can say collect from debtors early, early as possible, and pay creditors, later as much possible. So in this way, you can manage the finance working capital. Okay, so this can be another way of uh, arranging the finance SMEs. What is the next is crowdfunding. When the company arrange finances from large number of people. Okay, so when the so many people like 10 lakh people, sorry, the 1 million people invest 1 million, sorry, 10 million people invest a small amount, very small, like $10 or something in the business, or $100 or something in the business. So it is called the getting the finance from large number of people through online platform. And this arrangement is done online, and it is similar to donation, but it is not donation. It is a way of arranging the finance. Okay. Next is the peer-to-peer funding. What is peer-to-peer funding? Borrowing and lending money between unrelated individuals. It means if you are borrowing money and lending money as well. If you are borrowing and lending money between unrelated individuals or peers without going to traditional financial intermediaries such as bank and other traditional financial institution, there is no necessary common bond or prior relationship, which means that you don't take finance from bank or financial institution, and there is no need of bond or prior relationship. So how you get the finance? You get the finance from any person to your company. Any individual person give your finance to your company. Okay, so this is not from the bank. You take money from the individual persons that are unrelated, that you don't know them before. Okay, also there is no agreement. So next is the maturity gap. What is maturity gap? Long-term loan are easier to obtain than medium-term loan because longer terms are easily secured with mortgages against the property. So short-term loan are not easily obtained. Medium-term loan or short-term loan are not easily obtained by the SME. Why? Because SMEs have lower profit. So when they have the small profit, companies, so banks see them as a risky in the short term, because they think that in the short term they cannot pay this big amount, but in the long term they can pay this big amount loan. So they afraid to give them the short term loan or medium term loan, but they give them the long term loan. Okay, also the long term loan is secured against the property. So one another thing that they consider while giving the long term. Okay, so let's go to the next is Islamic finance. Islamic finance has the same purpose. It has the same purpose like the other forms of finance, but it operates in with the principles of Islamic law, means the Sharia. Okay, so but it has the same purpose but operates according to Islamic law. So, what are the main principles? The principles covered in the Islamic finance include the profit sharing, sharing of profit and loss. Okay, this is the uh, first principle. The next is interest is not allowed. No interest allowed means interest is riba. Riba. So sorry guys if I don't pronounce the words because I don't know how to pronounce all these. So if I mispronounce any word, okay. So the no interest riba is allowed. Riba is the interest. So receiving and taking, taking and giving interest is not allowed. Riba is not allowed as per Islam, as per Islamic finance. Okay, so the finance is restricted to Islamically accepted transaction. What are the Islamically accepted transactions? For this, we have to understand what are those transactions which are not Islamic. Okay, so investing in alcohol, gambling, etc. are not Islamic transactions. So if you take finance from a Islamic bank, you borrow money from Islamic bank and you invest in the wine business or alcohol business, then it is not allowed. Okay. Also, if you borrow money and do gambling or go to casino and win the betting and something like this, it is also not allowed as per Islamic laws. So okay, so another is the therefore Islamic, therefore ethical and moral investing is encouraged. Okay, it means ethical investing is encouraged. Instead of interest being charged, returns are earned by channeling funds into the underlying investment activity. So, so the instead of interest charged by the bank, how the bank earn by investment, instead of interest they earn money by the investment in the activity of the businesses. Okay, so which will earn profit, that business activity, that investment will earn profit, and the investor, that is the bank, that Islamic bank will be rewarded, by the profit sharing. No, after a management fee deducted by the bank. Okay, so the profit is shared between the provider, that is Islamic bank, and the owner of the business. But the bank will, I mean, the bank will charge some extra as a management fees. So if they have the like they have some mm, profit sharing, then I think this will get 40, but this will get 50-50 if they have the 50-50 ratio, but this will get 50-50. But because they provided the finance, so they will get the 10 as well as a management fee. So this will be also get the this 10 will also the income of the Islamic bank. Okay, so next is the main sources of finance. What are the main types of instruments in this Islamic finance, uh, so what are these? These are the banking models. These are the more maraba. Maraba is the trade credit. It is similar to trade credit. Ijara is lease finance, and sukuk is debt. It is that type of instrument, and madarba is equity finance, equity. Okay, so and musarka is venture capital. Okay, so let's do. let's understand further in the next slide. So here we have this Islamic banking broadly two categories. First is fixed and another is equity. In fixed is like that you the providers of finance, that is Islamic bank, will get the fixed income, okay, and the Mad- uh, Madarba and Musarka is equity, means risk taking. It means risk risk taking capital. Is risk taking capital they are providing. It is debt like instrument, it is debt like capital, and it is equity, that is risk bearing, or you can say risk bearing capital, that is provided by the Islamic bank. Okay, so Maraba is the form of trade credit or loan, trade credit, which means that it is a distinction between Maraba and a loan is that with a Maraba, the bank will take the actual constructive or physical ownership of the asset. The asset is then sold to the borrower or the buyer or with a profit, and they are allowed to pay the bank over the installment. What does it mean? So it means that if you, as a person, if you need money, and this is the bank that we have, this is the bank we have, this bank is Islamic bank. Okay, so they will ask you, what will you do, why do you need money? You said that I want money because I want to borrow an asset. So you want to borrow asset. Okay, so because we cannot give you money and charge you interest, because it is not allowed, so what I can do, I can buy this asset, I will buy this asset, I will buy the asset buy from market. I will buy the asset from market. I will be the owner. The Islamic bank, but I will provide this asset to you. I will provide this asset to you, physical ownership, and then I will charge you the, I will charge you the the I will transfer you at the, for example, I bought this at 100, so I will give you at 100 plus the my I will profit. This is, that is 10. This is my cost plus this is the profit. So I will transfer this to you at 110. So you have to pay me this 110 into, for example, if you are providing that into 10, if you are providing, if you give me into, if you return me into 5 years, then you have to pay me $22 $22 every year. Okay, so this is called the trade credit, or you can say murabba. It means this is a contract of cost plus profit contract. So instead of providing you the money, they are providing you the asset by buying itself. When you pay that full amount, then they will transfer you the asset. Okay, the ownership of the asset. They will transfer you the ownership of. So the period of repayment could be extended. This period of EMI can be extended, but no penalty. There is no penalties, and additional markup is added by the bank. Early payment is also not rewarded, and there is no penalties as well. Okay, so not welcomed, but although the financer may choose to give discount on the contract. Okay. Next is the Ijara. Ijara is the equivalent to lease finance. In this, it is defined as when the use of underlying asset or service is transferred for the consideration. Under this contract concept, bank makes available to the customer the use of asset or equipment such as plant, office, automation, or motor vehicle for a fixed period and time. Big bank provide bank provide bank provide bank provide what? Bank provide the plant like asset, any asset, and they will they will charge that I mean, you provided the asset on a lease, you are the owner, but they will charge you on the lease. So you have to pay the lease, some rent, pay the rent, okay, lease amount over the fixed period. So it is similar to lease contract, but here they will buy the asset and they will transfer you at the cost plus profit. But here they have the asset and they will transfer you with the on the basis of lease rental. Okay, so in this contract the leased asset must be specified in the contract. In this contract the asset is specified. The lessor is the bank, is responsible for major maintenance of the asset and he is the owner. Okay, so major maintenance, like if they are providing you uh, the house, for example, if they are providing you the house, so the major expense could be the repair and maintenance of roof of the house. But if the lessee is responsible for the maintenance in good shape, which means if they are providing the house, then you have to maintain it by doing and and small repair. Okay, like leakage of water on anything, something like this. Okay, so next is sukuk. Sukuk is another source of finance. So guys, remember that you have to just understand these basic meanings, I mean the basic concept, the words, and that is according to Islamic finance, and what is according to our finance management. So you just have to remember what is sukuk, what is this. In this chapter, you will only be asked for 2 to 4 marks questions from this topic, but not more than that. So you just remember what is all these meanings according to the principles of Islamic finance. Okay. So next is sukuk. Sukuk is within the form of business finance. The company can issue tradable financial instrument to borrow money. Key features of debt instrument. It is similar to debt. Do not give the voting right, so debt holders also don't have the voting right, and give right to profit before they have the right to profit before distribution to equity holders, shareholders. So they will get the interest, like in the debt holders they get interest before it is paid to the shareholder. So it may include securities and guarantees over the assets. You know that debt is secured against the company's assets. Okay, so include interest based element. All of the above is prohibited under the Islamic law. But all these things are prohibited under the Islamic law, all these things, okay? So you cannot do voting in the company, and also the right of distribution, the preference is not allowed, and security and guarantee charge against the asset is not allowed as per Islamic law, okay? So instead, Islamic banks are linked to Islamic bonds or sukuk are linked to underlying assets such that the sukuk holder is the partial owner in the underlying asset, and profit is linked to the performance of the underlying asset. So instead of the debt holders have the voting right and all these things, the what here in the Islamic bonds, they have the they are the owner of the underlying assets, and profit is generated by the company's asset, and they will be distributed among the sukuk holder. It will participate in the as a owner of the company issuing the sukuk, and has right to profit, which will equally bear their share of any loss. So instead of the debt holders will be take the part, and this is the this debt is linked to above the bonds is linked to asset. If the asset appreciate, this debt will appreciate and make a profit, okay? This will make a profit, and the profit or loss is shared between sukuk holders, the sukuk holders. Okay. So another is the uh, Madarba is like a partnership partnership come equity, you can say. It has the features of both. Madarba is a special kind of partnership where one partner give money to another for investment in commercial enterprise. The investment comes from first partner. In this means partnership means one or more owner. So here we have two partner, that is Rab, Hul, Mal, and Mudarib. Mudarib. So Mudarib. So the first partner, the Rabal Mal. So the this first partner will give the will give the will gives okay will give the finance or fund, and the second partner will provide management management knowledge, you can say knowledge, okay? The second partner provide the knowledge of how to manage the fund, how to is okay. This is a special kind of partnership where one provide fund, other provide the knowledge, okay? One provide fund, other provide knowledge. And after the knowledge of this person and the provider of finance, if there is any profit in the business, that profit is that profit is shared between parties in agreed ratio. It is shared between agreed ratio of the land of the lender of the money that has taken loss. So it is if there is any profit is distributed between both. Profit is distributed between both. But loss is only distributed between the provider of finance, okay? Provider of finance, okay? So those loss is only belongs to the provider of finance, but profit is given to shared between both of the parties. So this kind of arrangement is also like in equity, the equity holders take the risk of losing the money. So equity like partnership come equity contract. Okay, the last is the Musarka. Musarka is a relationship between two or more persons who contribute capital to the business and divide the profit loss on pro rata basis. So Musarka is like venture capital in which there are two providers of venture capital, the first one and second. So the first one and second is closely aligned to venture capitalists. All providers of is entitled to participate in the management. The first venture capitalist and second venture capitalist both both participate in management. Participate. This one also participate, and this can also participate. It is not compulsory, it is just optional thing. So if any profit is made, then that profit, if the profit is made, if the profit is made, then it is distributed between first and second. Okay, both distributed among partners in what ratio? That is ratio agreed. That is ratio agreed. Ratio agreed. While the owned by the strictly in proportion to the capital contribution, and that ratio may be defined by their capital contribution. Okay, so that's all. You just have to remember what is uh, the name in the as per what are the name as per Islamic finance, these names, and which type of some basic understanding what is the principles as for the Islamic finance, and what are these closely linked to our as for our financial management in ACCA. So you just need to remember all these. So it is not worth many marks, but can help you to gain some marks. Okay.
Hey everybody, my name is Neeraj Sen. Thanks for watching. If you are benefited from the lecture, consider like, share and subscribe. If you have any questions, leave them in the comments below. I will meet you in the next video.